Hey, good morning, everybody. It's Jerry Maniak. Happy November. What do we got here today? Anyways, it's November 25th, and I know we're going to be heading into kind of a lovely Thanksgiving week here. But before I get going, I just wanted we'll get the call going here in just a little bit. I'll give everybody a few moments to kind of get settled in here, and then I got a fun call for you guys. So we'll just hang tight. We'll get going here in just a little bit. If you've made it on the call, don't worry. Nothing's freezing up or fluking out here. Just Jerry Maniak here on the call here today. And we'll get started in probably about another minute here. Just giving some time for everybody to get on the call here. So look forward to spending 30 minutes or so with you guys. So hang tight. Again, we'll get going in just a little bit here. All right. Well, good morning. We'll get the show on the road. It's Jerry Maniak here, as the tradition goes here. On this last call of the month, I've been taking this call here, and I got some fun stuff here. So excited! We got the Thanksgiving week here is upon us. I always think it's a fun time, and I always like to kind of look back and reflect and be thankful for a lot of the things that I have in my life and team and you guys. You guys have worked with you guys for many years as I've been with 5Q Group, and very grateful for a lot of the relationships and the people that I've met and all of your guys' efforts. So number one here, so just kicking things off, I love the 90s, not only because it was obviously formidable for the years that I was growing up. I think the 90s are great. And if you haven't noticed, it looks like a lot of these 90s trends are coming back. It's kind of funny. I don't know. I don't always like it when the trends and the things are kind of moving back. I haven't been following it, of course, but primarily the reason why I want to bring that up is in the 90s, if you had a portfolio that was 80% S&P 500, 20% in bonds, over that course of that time, you would have had around a 16.3% average rate of return. So how many guys would love to be able to get their clients a 16% return over a 10-year period? I know that I would. It would be awesome. I know that anybody and everybody would love to be able to have that 11.3 standard deviation and a 1% Sharpe ratio. So if this is the case, I mean, this is awesome, exploding, outstanding. We love the 90s. We probably would say, hey, you know what? Moving into 2000s, this setup would be working, so we would want to do that, and we'd say, hey, let's go ahead and do that. Well, flash forward, we all know the story there. What we would have made zero or negative over the next 10 years had this been what we were set up in. And so that kind of the reason why I bring that up is because recency bias is something that, hey, this is how they've been working, so they're always going to continue to go that way. And recency bias is one of the things I'm going to talk a little bit today about. But it comes back, and it's just kind of a human nature type of a thing that whatever's been what we're most used to or most recent, we tend to have some bias that that's the way things are going to go, and they're going to continue to go. And we all know, I mean, we're smart. We try to pull ourselves out of some of these emotional tendencies, but it's really a real thing, recency bias. And here's kind of a funny example of that. And it goes really actually, with us too as well here. Recency bias. Why did I buy a 4-wheel drive car? I'm looking at it right here, and so record snowfall. I'll look at it, in not record, but your average snowfall actually over history in Minnesota is around 45 to 50 inches. And I'm looking outside right now, and it's not even brown outside, it's green outside. And last year, it felt like we had average temperatures in the 40s, which is really rare. And so you can fall into this idea that, oh, hey, why do I got the snow blower? We don't get any snow here. But knowing that the average over, the last 100 years is around 45 inches, it's probably a pretty good idea. To have a snowblower. So recency bias is kind of an interesting deal here. So investor versus speculator. So one of the interesting things I just kind of find when looking at this type of a deal is you have if you look at Warren Buffett. Warren Buffett is a guy who Warren Buffett. He looks to I would ask you, is he an investor or speculator, or does he buy stocks? Does Warren buy stocks? And what I've learned or what I've seen is Warren doesn't buy stocks. He actually buys companies. So he's someone who calculates the stock's worth based on the value of the business. He's going to judge the marketplace by his established standards of values that he has. And then what he does is he buys a company, not the stock. He's not worried about the ups and downs, the recency bias, the things like that. He just pulls the whole up and down of the stock market out of his decision making, and he buys a company that he believes is a great company that's going to be great for a long term and has been great, and then he holds on to the company and then basically ignores the stock market and then holds those companies to a certain time. And we all kind of know that's when everybody kind of gets concerned, is when he's out there and he sells a company. Like, what does this guy know? He's kind of a big mover. Versus speculating is, looking, someone who gambles that the stock will go up in price because somebody else will pay even more for it, or based on their standards, value upon market price. And really, there's a lot of speculating that goes on. So big difference between investing and speculating there. But that's one of those areas where recency bias can come in and kill someone. And my example with Warren Buffett is here's a guy that, staying away from that, he just goes and he buys companies based on what he feels about them and just holds on to them. He's not worried about getting in the high and getting in at the low there. So kind of interesting comment here from Ray Dalio. The biggest mistake investors make is to believe that what happened in their recent past is likely to persist. They assume that something that was a good investment in the recent past is still a good investment. Typically, high past returns simply imply that an asset has become more expensive and is a poor, not better investment. And I think that's something that many times we forget. Another example, recency bias, and this is just human nature by so many people too as well. And it's just that feeling of what's been happening, it's going to continue to go, and it's the emotions that we deal with when it comes into investing. And I'm going to touch on some of that more in a little bit here too as well. So Howard Marks from Oaktree Capital Management. Rule 1, most things will prove to be cyclical. Rule 2, some of the greatest opportunities for gain and loss come when people forget rule number 1. And that's just that history is going to repeat itself. Where the market's going and everything, this kind of gets into averages too as well. We're talking about snow. I mean, S&P 500's averaged, roughly in that 8, 9, 10%, including dividends. And so when we get away from the mean, and we'll talk about that here in a little bit, eventually things come back down. And so that's where a lot of people get burned, is with recency bias. Everybody assumes when the market keeps going up, 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 and up, that's what it's going to continue to do. But when we get away from the averages, eventually it has to come back to the mean. Seth Klarman, most investors are primarily orientated toward return, how much they can make, and pay little attention to risk. How much they can lose. So I would say that, if you look at it, when do people pay attention to the risk and how much they can lose? Probably when they're finally losing. That's when people tend to start getting concerned about risk. Otherwise, we're riding the emotional highs of our wins, and those are just some of the natural things that take place in human nature. That's why buying low and selling high is tough to do. Naturally, that's something that we want to do. We look to be able to do, but we'll kind of go into that in just a second here. Buying low and selling high, we'll take a look at. This is kind of an interesting graph we had here, I found. Kind of goes through the emotional status of human beings when you're going through the buying and selling cycle. It's actually kind of funny because I think it's really true how so many people, these are the emotional status, because what we want to do is we want to buy low and sell high, but naturally, because of emotion from human beings, we end up doing what? A lot of people end up doing the opposite of it. So if we walk through this here, so here, the price is going up here. Let's watch the market. The trend is holding. We're going up. I'll buy at the next consolidation. Darn, I missed the consolidation, but if I wait any longer, I won't profit from the trend. Let's buy. So I end up buying here. Good thing I didn't wait here as we're going up here. And then as it starts going down here, I'll use this correction to increase my position. So market starts heading down here. I'm going to buy more. Brilliant. It's at this price. Let's double. Let's get in more here. It keeps on going down. Ouch. As soon as it goes back up, I'm selling out. Yep, I'm going to get out as soon as it goes up. This is too much for me. I don't believe it. It's down 8.25%. It's hit its absolute bottom. Okay, good. Good thing I sold everything down here. So now we're at the bottom here. It's going to tank again anyway, so who cares that it went up here? Told you so. Hey, it's back down. Then it starts popping up. You what? What the hell? More crazies are going to take into the cleaners. It's going up. I can't believe they would buy anything. This is it. I knew this was going to happen all along. And then darn, I should buy again once it came back up. It's cheaper than it was last time anyways. I just find this funny. And if you look at, when there's record flows of money coming out, where do they generally happen at? Where do the record flows happen? They're not happening up here. When this is actually where we should sell when it's up. We should be buying down here at the bottom, and we should be selling here up at the top. But where all the record flows out happen? They all happen down here at the bottom. And where do the record inflows happen? Up here at the top. And so that's completely against the rules of investing, which is buy low and sell high. But it's kind of a difficult one to manage with emotion here. So the speculators' deadly enemies are ignorance, greed, fear, and hope. All the statute books in the world and all the rules of exchanges on earth cannot eliminate these from the human animal. And so it's just the natural tendency when emotions get involved, and there are emotions, and that's why we got to pull the emotions out of investing. And that's, a lot of times that's what we talk about having a fixed index annuity. I was going to get into that in a minute here, but that's why we have fixed index annuities, because they help take the emotion out of investing. As Mike likes saying, we've kind of talked about, they buy low and they sell high automatically. Now, not exactly to that point, but with FIAs, we all know, when we get to our high point, we make our money there. We lock in as soon as our gain. At the end of the year, we lock in our gains, and we don't have to worry about any losses. And then when the market goes down, then we don't participate in it, but we get to start over in that lower dollar amount, and we get to ride it back up. So it can buy low and sell high for us. So and it takes the emotion out of it. That's most importantly, is you don't have to worry about making a bad decision to get out, or you don't have to worry about getting back in to the market at the wrong time. It's going to be able to get in for you on that annual basis there. So it's not whether you're right or wrong that's important, but how much money you make when you're right and how much money you lose when you're wrong. That's why when I'm at the roulette table, I like to make really big bets. I'm just kidding. But this is, again, it's that's why we like FIAs, because when we lose, we never have to worry about how much money we're going to lose when we're with an FIA, because we always get zero. And that's the core principle of fixed index annuities, is we don't have to worry about taking those losses. And guys, right now we're in a place. I've had some people. I know, and the markets are going great too as well. But now's a great time. I've had some people saying, "Hey, the markets are great right now. I'm going to wait till things cool off a little bit, and then we're going to get in, and then I'm going to start writing some more fixed index annuities." Well, we just went over that just a little bit ago too as well. This is the time right here. This is the sell time right up here. This is the buy time. So it's what I would say is it's never a bad time to be in fixed index annuities, because we're going to get the market up to our certain percent. We have caps that are between 8 to 10% right now. 100-year average S&P 500 is at 9 to 10%. So that's not bad for an investment that we can get. We don't have to worry about it losing any money on. It's always a good time to be able to do that. And you know what? The most important thing is when you have a balanced portfolio where we're not ever saying, hey, let's put everything over there, but we have our buckets, and you have that safe bucket that we can get our zero. Just because the market's going great doesn't mean you should be 100%, on the equity side. And I think that's what I love absolutely about FIAs is when you are wrong, you're not wrong, because you just get a zero. So Wall Street Journal here, regression to the mean is the most powerful law of financial physics. Periods of above average performance are inevitably followed by below average returns, and bad times are inevitably set the stage for surprisingly good returns. And that's good news. And the funny thing about this is it is kind of physics. Everything regresses to the mean. So we're going to come back to the averages. So when we're way above average in a certain area, it's going to come back. These are the laws of physics. It does come back eventually, and it's happened. We'll look at a couple sides where it's happened over time for 100 years. It's just how it works. So looking here, we have the average right here. We're kind of coming up and down, and every time we end up getting over, we end up popping back down. Here's a average right here. Here's our average here, and we end up coming back to our average all the time. This is our average line, and every time the market ends up popping over it, ends up coming back down, comes back over, comes up popping up, ends up coming back down to the average. I like one here. We're going to be coming up here again. Here's a 10-year annualized. I should actually get a more updated slide here, but it still makes the point. 10-year annualized nominal returns from large cap stocks from 1834 to 2013 here. 8.6 was the percent is the average rate of return. And every time, here we are, here's the average. This is over 160 years here. Our average rate of return of these large cap annual stocks, when they fly over the top here, there's plenty of times we came over where our average rate of return is in the 15% range. It ends up coming back down. We end up dropping below the average rate of return. And plenty of the years here, when it goes far below, our average ends up getting brought back up here. So over from 1834, it's all up to 2013. The point is we revert back to the average is what ends up happening. So when we get way overvalued or returns get over high, things are going to come back down. Here's a reversion of the mean 10-year trailing PE. So same thing with price to earnings ratio too as well. When our PE gets too high, 18.3 is the average. What does it do? We know that we're going to end up we know when we're way overvalued here, we're going to end up having a correction that ends up taking place. And like we said, regression of the mean is a law of physics. It happens. It always happens. It's a law of financial physics that we want to pay attention to. And it helps us act sane when it comes to investing too as well, to have our antennas up to kind of what's going on, knowing that over history, this has always happened. Jeremy Grantham, you don't get rewarded for taking risk. You get rewarded for buying cheap assets. And if the assets you bought got pushed up in price simply because they were risky, then you're not going to be rewarded for taking risk. You're going to be punished for it. So, and it kind of goes into, we could just go out and buy cheap assets, but, and that kind of makes some sense. Like, hey, you would want to buy, cheap assets, things that are lower in price, but we typically don't do that because those are the ones that really, the kind of a lot of the riskier assets are the ones that are making money. And if you're trying to convince a client to buy a company that's not real sexy or, really hadn't done real well, but it's cheap, no one's going to do that either. So, it's just tough because everything that's doing well is a lot of the riskier assets, but it goes against some of the, unless you're doing your real tough research on that, it's real tough to do that. So, Jeffrey Gunlack, the trick is to take risks and be paid for taking risks. Those risks, but take those risks in a diversified basket of risks in a portfolio. And so I agree with that. I think with Nest Egg, and he talks about diversified portfolio, and that's where I think it's important. That's why it's important to have fixed index annuities in the portfolio. We obviously never have to worry about taking risks, but if you're looking at building I always talk about building a diversified portfolio of assets. If you have a diversified portfolio of assets, and we have the story in the 21-point checklist where you have all these different baskets of eggs, and they're all sitting in the back of a truck, and that truck hits a pothole, how good are all those different baskets going to do for you? And I would call the pothole, look at like 2008, where many of the different asset classes end up getting crushed in 2008. I would rather at that point, have, if I had a basket of eggs and they're sitting in my lap in the front with me, and I can lift it up when I hit that pothole. That's the kind of diversification that I want. And what I'm talking about is that diversified basket or portfolio that you have in your lap. That's your fixed index annuity, because it doesn't matter what's going on. When I have that, I'm not going to have to worry about taking any loss. I don't have to worry about redemption risk. I'm not worried about the stock market. And I'm not saying, again, we abandon those things. These are all great parts of the portfolio. But fixed index annuity, having this available there for us, we always talk about what a great portfolio it is when there's a lot of different ways you can do things with, income riders or just growth products. But I love like the simple portfolio, and Mike always talks about promising, I only like to promise the things that I know I can deliver on. And so when you have a portfolio, when you can tell people, hey, look, we're going to have market accounts that when the market goes up, they're going to go up and they're going to do real well for us. And when they go down, it's going to go down. But the reason why, but we're okay with that. We understand that. But we're going to have another product over here where a fixed index annuity, where when the market's up, we're going to get part of that return. And when the market goes down, we're going to get a zero. And when we're taking, this is a whole nother discussion. And then when we're taking money off those assets, when the markets are down, we don't have to worry about locking in losses, because we can take fixed index annuities, and we're not going to lose any money over there. And when the markets are up, we'll take off of our assets under management. And one of the funny points that I've kind of brought up and talked with a few guys about is, I've had some guys that when they're bringing on some new clients, I'd said, hey, you know what, here's something, a great when you bring a client on and they don't have any FIAs in the portfolio, you can identify, and I've talked to guys about this that didn't have any FIAs in a portfolio, and they're like, gosh, you know what, it feels like, so first of all, I said, look your managed money portfolio, how much of that portfolio, if you have like a moderate portfolio, how much is in bonds, right? How much is in there? I have guys who'll tell me, 30, 40, maybe 50%. So I said, hey, what you can do is we can remove, on its corporate AAA bonds or whatever in there, you could remove the bond part of that, put the equity part more aggressively, take the amount that you're going to have in bonds or inside of that portfolio, and then let's go ahead, we can put it in a fixed index annuity. We're going to get the client way more return, less risk inside of the portfolio too as well. And guess what? If it was 40%, you just cut their fees in half by 40%. So immediately if you're bringing over a client that's 100% or is in managed money, or 100% managed money, or 60 whatever, that you're going to be able to reduce their fees by 40% right off the get-go by moving over an FIA. And then I've kind of had guys as well, what could maybe be one of the other issues? I've had some guys that look, I don't want to cannibalize my trail. And that's fair enough too as well. If you really want, most FIAs have a 1% trail that's in there anyways. And the great thing is that trail doesn't come off the client's asset. So it's a great way to be able to do something fantastic for a client and help them eliminate more of that risk and get them better returns. So kind of jumped off the rails a little bit there, but nothing better for a diversified portfolio than having fixed index annuities inside of it. And then we don't have to worry about ever breaking that nest egg too as well, which is the most important thing when we're dealing with retirees, and is helping them to continue to maintain the lifestyle that they're currently living. I mean, that's what people want. I don't think people, they're looking to have a better lifestyle in retirement. They want to be able to have the same lifestyle in retirement, and putting them at risk, unneeded risk when they don't need to, is just crazy. So, question: should someone retire if they don't have enough money? Should they retire if they don't have enough money? No, it's crazy. Should we tell them? What are the options that we have? Should we tell them, hey, you know what? We can grow you out of that problem. We talked about, though, to more return equals more risk. So I think that's, if someone doesn't have enough money to look and they can actually retire safely without having to incur a tremendous amount of risk, then we probably shouldn't do that. And it would be crazy to tell them, hey, let's go ahead and we'll help grow you out of this problem. We'll take 3 times as much risk as we could to get there. And we don't want to do that, because we'll probably end up putting someone in a worse position, right? So we definitely don't want to do that. But let's say someone has enough money to retire. Someone does have enough money to retire. Well, if they do have enough money to retire, that's awesome. They can live the life. And what kind of lifestyle do they want to live? Most people would like to live, if they can, something similar to their current lifestyle. I know most people aren't saying, hey, I'm going to retire and we're doing this, and I'm going to try and have a far better lifestyle than I currently was living when I normally was retired, short of the fact that they're not working, right? But financially, and the things that they're doing, they want to eat, they want to go to the restaurants that they're going to, they want to play golf maybe a little bit more, and they want to hang out with their grandkids, they want to vacation a little bit, but you're obviously not driving to work anymore, and there's some other items that bring costs down. So you basically want to be able to live a version of your life a little bit more the way that you want to do it, and not have to work, right? And so if we look at things, what do we need to do to be able to continue to do that? Well, obviously, one of the things is we need to be able to, I don't necessarily need to, what I need to do is probably be right in inflation range. And inflation's a little bit higher. I know it was here in this 2 to 3% range. I think depending on the items, I can't remember all the numbers where we're exactly at right now, but what are we in this 4 to 5%? Maybe you could even say 4 to 6 on some items. It's been getting pushed down. I know that. So there's some items that are a lot more expensive, but I know there's some that have been a little bit lower. But my point is that inflation, once we get to retirement, is one of the items that are, and then there's medical costs as well in there. But inflation is probably the biggest thing for us. And so, if we need to keep up with inflation out there, that's basically what you need to be able to do. And so, with fixed index annuities right now, and where caps and rates and where things are at, you can probably, I like to safely tell people, you can get a lot more. I've seen some people that had some returns that are 12 to 15% this year, but where you're really at is you're looking in that 4 to 6% range, and we can easily hang there on something that's safe with a fixed index annuity and get between 4 to 6% rate of return on it. And so the crazy thing is if I can do that, and I can handle and do that safely for someone, and I can help keep them, so I can keep it safe, worry about losing, and I'm not going to put them in any risk. In order to, the market average has been over the last 100 years is around 9-10%. Does it make sense to overtly take this tremendous amount of risk? If I can get 4 to 6 safely, and I can live the lifestyle that I want to live, we used to always have this in the saying. We'd say this in seminars, and we would talk about this. We'd say in a seminar, we'd say, "Hey, raise your hands, the seniors. How many of you would take willing to put your portfolio or your retirement lifestyle you have at risk to make another 3 or 4% in the market?" Nobody would raise their hand. Just so, and because this way you can put your retirement at risk. That way your kids or grandkids can have more money, and no one would do it. But we get so caught up with getting return, and I think that's awesome when people, before they retire, but once they retire, it's really about, for most people, it's really about their lifestyle and less about the returns. Because if you look at it, and we've talked about this many times, if you end up making some, let's say they're in retirement, they're taking income, they're living their lifestyle, and you make them a 20% return that year, are they going to go out and take that money? Wow, my life has drastically changed. So we're going to trade in our 3,000 square foot middle class family home, and we made some great returns. So we're doing so good. We're going to move our payment up, and we're going to go buy a huge house. I'm going to get a bigger house now. Life has changed. I'm going to go trade in my Nissan, and I'm going to go start driving a BMW or a Mercedes Benz. No, no one's doing that. It doesn't happen. So it's, but I would say on the flip side, if we were to lose someone 15%, if you're to lose them that, we all probably experience this. When you losing something in retirement, how does that change their life? Makes people a little stressed. I know I've seen people that, all of a sudden, the concern of that, all of a sudden they want to continue to go have their steak dinner on Friday night, go play golf in the morning, and all of a sudden they're like, yeah, you know what, we can only do that every other, because we just have concerns, because what happens if it continues to go down? So we can definitely change the emotions of someone in retirement when the market goes down. And I think it really does change their life, but it really doesn't drastically change anybody's lifestyle when they're seeing over and above average rates of return. And the point is I take additional risk on someone than they really need to be taking, just to be able to, because they can get a little bit more return. I think return is less of importance as they get older. Keeping up with inflation is important, but getting large returns and taking risk or unneeded risk doesn't make sense. And I think so many times, and this is kind of summarizing the call, so many times return becomes such part of a forefront instead of protecting lifestyle for people once they're there. And that's what's so important. If someone has enough money to retire, we want to protect their lifestyle and keep them in a position to be able to continue living the way that they currently are. It's not as much about just getting large returns. And FIAs and MYGAs and Index UL are great ways to be able to get return, to be able to protect against inflation, and to be able to keep us up with inflation and protect us from downside risk and be able to get people income. And so, don't get, we love the market, we all do. But my point is there's always a regression to mean. That's the laws of the financial physics. And when we get out of whack, it's difficult, because things are going to come back down, and it's the emotion that goes on out there that makes it difficult to think clearly when the markets are moving. But we do know regression to mean is obviously something that always ends up happening. So FIA is obviously a great way to protect the nest egg, and if we break that nest egg, that's a difficult one for our clients to be able to swallow here. So you guys, we have the hardest job in the world here, guys. We really do, and you guys do a great job at it. One of the tough things is you can never make clients happy enough. And what I mean by that is it's nuts, because you could get your client a 20% rate of return, truly make them happy. I know people are like, hey, this is swell, I made 20%, but you make your client 13%, and it can be like, well, it's a little expensive, and you know what, I noticed I can get an S&P ETF. It did 3% more, and I could get it for 5 basis points. Or my buddy Bob down the street, he got 20 and I got 13. Or my daughter-in-law, my daughter's marrying a horrible guy. Is he gonna be happy then? So there's so many things that it's not going to thrill someone in their life because they get some great return, but we sure can make them unhappy. So if the market goes down, there's people they don't like it. It's pretty easy to make them unhappy if the market goes down, and I can't go to them and say, hey, you know what, we had a great tactical management in this portfolio, so they're not going to feel like winners when you say, hey, we only lost 15, but the rest of the market lost 25. I mean, someone may recognize, there may be, I'm not saying there's someone out there that doesn't have a story of a client that bought him a birthday cake and was thrilled because of that, but really most people aren't going to care. I mean, if they lose, they lose. So that's why I always, the idea of tactical management and trying to sell a story where we're not going to make as much on the upside. We'll make a little bit less, but guess what? You're not going to lose as much on the downside. To me, they're still losing on. I would rather just use a fixed index annuity and pump that in there because we aren't going to lose on the downside and we are going to gain on the upside. So having the still losing is losing to clients. You can't really they're still going to be unhappy about it. So I appreciate you guys spending a little time with me. I hope I wasn't too preachy about the FIA, but obviously there's a lot of great products and things going on right now. Rates are kind of standing still with it. I think it's a great time, keeping people balanced. Fixed index annuity is a great part of it for the portfolio, putting it in there. Talk to the team, Dan, myself, Nate, and we're happy to chat with you guys. There's some great stuff out there right now. And, look at those, besides, replacements, we've been getting some phenomenal traction on the Roth conversion strategy. If you haven't dug into that, I've done a couple calls on it, and it really is a game changer, a unique way to position that. And we've had some really large cases coming in on that for people that are interested in doing Roth conversions. I don't think that I don't ever try to convince people that Roth conversions are the best thing for them, but there's a lot of people that want to get in a position where they're not paying taxes on future gains. Being able to do the internal Roth conversions with some of these carriers and getting that, the big bonus to help offset taxes is really exciting. And we've had some good traction now since we've been talking about it. So, but hey, happy Thanksgiving, and thankful for all of you, everything that you guys are doing. You guys do great work for your clients. And, I'd love to talk with you too as well about, 2025, some 2025 planning, looking at marketing plans, maybe some of the things that you want to do that are new this year. You can talk with myself, talk with Dan, talk with Nate too as well. Whether it's implementing, getting the some different areas of the 21-point checklist more fully adequated and implemented into your system and process, or maybe there's some marketing efforts. Hey, we talked about a couple of weeks ago some of the inexpensive items that we can do, whether it's holding birthday parties, client appreciation events. There's a lot of cheap and inexpensive ways to get in front of people this year that aren't going to cost money, that are highly effective. So if you want to implement some of those things, happy to talk with you about best way to do that, or the guys are too as well. So you guys have a fantastic week. Happy Thanksgiving to you. You guys are a blessing, and we'll talk to you next time. Thanks, guys.